Hello, this is Professor Hazara. Um, we talked about intercompany inventory transfers last week. This week is going to be the week for intercompany fixed asset transfers. Now, I'll be giving you a couple of assignments on Brightspace for the inventory transfers, just so you can refresh yourselves. And then going into next week, you'll have a couple of assignments on fixed asset transfers. So we'll be overlapping a bit. And these will both be on the final, so I would expect you to do fairly well on these, or to at least spend some time on. Okay, and like I said, for inventory and for fixed assets, there's two things basically I want you to know. You could say there's three, but there's really two things. Number one is the theory behind the consolidation journal entries. And what I mean by that is, why do we make the theory? Why do we make the consolidation entries that we do? So we're going to have to make certain adjustments for both inventory and fixed assets when they're sold on a downstream transfer from the parent to the sub, or an upstream transfer from the sub to the parent. The other thing is that I want you to be able to handle these things in both the equity method and consolidation, and they're both basically the same. So these next two videos, these both are going to be on the theory of fixed asset transfers, and the final three videos, there's going to be a total of 5 videos on fixed asset transfers. I hope they're relatively short, each one. So the first 2 videos will be theory, and the final 3 will be consolidation example. Okay, and this is going to be the lecture basically I give you on December 1st, which is the theory of fixed asset transfers. And then what I'm going to do is give you a consolidation on Thursday, December 3rd. Okay, so anyway, let's go through fixed asset transfer. Okay, and I'm just going to go ahead and go through an example, and then you do the theory that way. Okay, so let's say this is a downstream transfer, and let's say that on 11x1, here's all the text. P sells a piece of equipment for $500,000 to S. The equipment was sold for $500,000 cash, and it has 3-year remaining life. Okay, so at the time of the sale, the equipment, go through this, and at the time of sale, the equipment was recorded on P's books as follows. It's recorded on P's books as follows. Number one, P had paid $600,000 for the equipment. They had recorded accumulated depreciation of $300,000 for the equipment, and the equipment had a net book value of $300,000. Okay, so what's happening is that P on 11x1 is going to sell this equipment to S. So P is going to wipe it off its books. And I'll go over all the journal entries next time. So P is going to, in the next video, so P is going to wipe this piece of equipment off its books, and S is going to record it at what S paid for it. Now, what happens then is that, in essence, 3 accounts are going to be misstated. Okay, and the accounts that will be misstated are property, plant, and equipment, or whatever the fixed asset account is. So plant and equipment will be misstated for the remainder of the asset's life. And the reason is, if P wipes it off his books and then records the asset sale basically on a sale to itself, because it's an intercompany transfer, so it's a sale to yourself, it's going to take the books, the correct asset value off the books, make it 0 on P's books, and it's going to be recorded by S at the new cost of $500,000. You'll see all this in the next video. Okay, it's also going to wipe off the accumulated depreciation. So P will take the accumulated depreciation, sell it to S. P will make the accumulated depreciation 0, and S will actually start with the new accumulated depreciation. And then finally, because P is taking both plant equipment and accumulated depreciation off the books, making them 0, that means that the depreciation expense for the remaining life of the equipment is going to be 0. And you'll see all these entries. Okay, but this is just the introductory video. In the next one, you'll see the actual entries that we have to make. Okay, so basically, for the rest of the life of the equipment, there's going to be 3 accounts that are misstated: plant equipment, accumulated depreciation, and depreciation expense. Okay, and so we've got to know, the first question is, we've got to know by how much these accounts will be misstated by, in order for us to be able to make the adjustments to go from the post-intercompany transfer amounts to the pre-intercompany transfer amounts. Okay, and really, there's two key numbers. If you go down here, there are two key numbers to calculate before preparing any journal entries. Okay, and the question that you're always going to ask in both calculating these numbers and in calculating the correct journal entries, and this really, I'm not just going to put this in bold and put it in red. I'm going to go ahead and put this question, make it big. The question you have to keep asking yourself when we do this type of entry, we do these entries when there's a intercompany transfer of fixed assets, is what would the account balance have been on P's books? This is a downstream transfer. This would be on S's books for upstream transfer. We're sticking with downstream transfers for now. What would the account balance have been on P's books at the date of the consolidation had the transfer never occurred? So what you've got to keep doing is calculating what P would have had on its books had this transfer never occurred, and those are the correct numbers, comparing it to S's actual numbers, because S actually owns the equipment now, and then making the adjustment based on that logic. Okay, but to know how much you have to put into those entries, there's two key numbers you have to calculate. One is when P records the transfer from itself to S on its own books, it's going to record a gain or loss. So, and that gain or loss is no good from a consolidated perspective. You can't sell yourself equipment and record a gain on the sale of equipment. And the second number you have to calculate is the excess depreciation. So for one number, before we get into the journal entries, there are two numbers you need to calculate. The first one is the gain or loss recorded by P, because that gain or loss will be not correct from a consolidated perspective. You can't record gains and losses and revenue on sales to yourself. And the next one is excess depreciation or lack of depreciation. So S is going to be recording the equipment on its books at a new cost here. That means that the depreciation would not have been what it would have been on P's books had this never occurred. Okay, so let's go through both these calculations, and then I'll stop there, and then these calculations will serve, just to show you getting ahead here, these are the entries that we'll be making here, and they're going to serve as the basis for those entries. Okay, so let's go ahead and we'll start with the first one. So the first calculation you have to do on all these transactions when you have an intercompany transfer is what is P's separate gain or loss? Okay, so let's go back to the text of the problem here, and it says P sold equipment for $500,000 cash. It has a net book value of $300,000. The net book value is plant equipment of $600,000 less accumulated depreciation of $300,000. Okay, so here's how the calculation goes, and these are pretty easy calculations. So the cash that is received by P from S on the intercompany transfer is $500,000. The equipment had an original amount, just the equipment itself. There was an original amount on the books at $600,000. I'll go ahead and format that seller, and it was less accumulated depreciation of $300,000. Okay, so the net book value of the equipment, the remaining net book value at XX1. So I'm going to write in here, remaining net book value at 1/1X1, the date of the transfer. So the remaining net book value on P's books is $300,000. Of course, P is getting rid of it. So the gain that P records is $500,000 minus $300,000. So this is P's separate gain on its books. Now I want to emphasize that this is the gain that will show up on P's books. And if you do nothing, it will show up when you add across on the consolidation. It will show up on the consolidation. So that's the first number you need to know. That P has recorded a gain on its books of $200,000, which will show up on the consolidation, but it's got to be backed out. And keep in mind that all gains and losses are close to retained earnings. So this year, in the current year, when the gain or the loss is recorded, you're just going to back out the gain or loss. But in the interim, in subsequent years, people have taken its gain or loss and closed it to retained earnings. So it's going to be the retained earnings or alternatively the investment account that you've got to impact. Okay, so that's the first calculation. Next calculation, you have to ask yourself, how much excess or lack of depreciation is as recorded. In this case, we're going to have excess depreciation. And the reason for that is P takes a piece of equipment, wipes it off his books, and then S records the equipment at its new cost of $500,000. So S is going to be recording a different amount of depreciation than P would have recorded had this never occurred. Okay, so let's calculate an amount called excess or maybe lack of depreciation. There's two ways to calculate this. Okay, so let's calculate the amount of depreciation that would have been on P's books had this never occurred. First, it's so P, if this had never occurred, at 11x1, P had a net book value of $300,000. The remaining life, as it says in the text, is 3 years. So P would have recorded $100,000 of depreciation each year for the remaining 3 years of the asset's life. This is the correct depreciation expense for consolidation purposes. And I go back to the magic question, which I put in big bold letters up here. The question you always have to ask yourself is, what would the account balance or expense revenue have been on P's books at the date of consolidation had this never occurred? Well, the annual depreciation expense would have been $100,000. That is the correct depreciation expense. Now, what is S actually recording this at? And S is depreciation after. I'm going to go ahead and move these down just one row here because I want to put these in here, and I'm going to do the same thing here. Okay, so I'm going to put here S's cost. That's the cost they paid for the equipment, which is $500,000. So they pay $500,000 for the equipment, and then you got the remaining life. The remaining life of the equipment is 3 years. 3 years. So S is actually recording $1,166,666.67, $167,000 depreciation basically. So what's happening here is, if this transaction had never occurred, P would have recorded $100,000 if this never occurred. Remaining net book value over the remaining life. S, the asset was transferred from P to S. P wipes it off the books, and S then records it at $500,000, which is what it paid for. So S is going to be recording $166,667. So S is recording $66,000 of depreciation too much. Okay, and so what you're going to have to do every year for the next 3 years is, this is the amount, $66,000 is the amount of depreciation expense that must be removed from the consolidation every year for the next 3 years. So it's $67,000 more or less. Now, I want to be very specific in that there is another way, and it may be a more practical way to record this, to calculate this $67,000. Okay, the only thing you need to do, an alternative way, is just to take the gain of the loss, and divide by the useful life, which is 3. That gives you the same number. This is same excess Okay, so you can calculate the excess depreciation by comparing what, on a downstream transfer, what S has recorded compared to what P would have recorded, which means that you're recording $67,000 too much. And then also, you can take the gain and divide by 3, and it'll give you the same number. So you can use either way. Now the question becomes, how do you know if it's too much or too little? If it's a gain, then you have excess depreciation. If this had been a loss, then you would have a lack of depreciation. So remember that. Gains result in excess. Gains result in excess depreciation. losses result in a lack of depreciation. So when you have excess depreciation, you've got to back it out. You've got to take it out. If you had had a loss and you had a lack of depreciation, you'd have to actually add it back. So, and the same holds true here. This gain automatically means that on a downstream transfer, the subsidiary will be recording too much depreciation. If this had been a loss, they would be recording too little depreciation. Anyway, so that's the initial lecture on fixed asset inventory theory. I will post this sometime this week and give you the assignment going into next week. Thank you very much. Bye-bye.